You spot it, a perfect hammer candlestick sitting right on your chart. It has the small body and that long lower wick you've been taught to look for. You execute a buy order, expecting the market to immediately reverse in your favor. But instead of a rally, price drops. Your position is swallowed whole by a wave of selling pressure, and your stop loss is triggered within minutes. That perfect shape didn't fail you. The issue is relying on a shape in the first place. A single candlestick is just a visual record of a momentary battle between buyers and sellers over a specific time frame. Traded in isolation, it is entirely meaningless market noise. To stop losing capital to these false setups, you have to stop acting as a reactive pattern spotter and start operating as a precision analyst. This requires a sequential, multi-factor filtering process. We call it the FXNX green light system.
It is designed to methodically strip away false signals by testing a pattern's context, anatomy, and structural confirmation. Long-term survival in the Forex market depends on your ability to systematically disqualify bad setups before a single dollar of capital is ever put at risk. This animated diagram shows our first filter, trend context. Notice how patterns trapped in the middle of a sideways range are deleted. A hammer and a shooting star are reversal patterns. This means they only matter at the absolute extremes. A hammer must exist at the very bottom of a clear downtrend, and a shooting star at the peak of an established uptrend. If you attempt to trade these shapes in a consolidating market where price is moving horizontally, the erratic, trapped price movements will trigger false signals and chop you up. The second filter evaluates anatomy. The power of a hammer lies in its elongated lower wick. That wick represents a moment where sellers pushed prices heavily downward, only to be aggressively rejected by institutional buyers, driving the price back up. The longer the wick, the stronger the rejection. Above that wick sits a compressed body. This small body demonstrates intense market indecision immediately following the buyer's rejection. After a massive push lower, the market ended up closing right near where it opened. We can strengthen this read by looking for confluence, which is when multiple indicators point to the same conclusion. If the appearance of this pattern is accompanied by a massive surge in trading volume, its validity spikes. High volume indicates that large institutions are actively participating in the price rejection. The probability multiplies even further if the candlestick physically rests upon a historically established support or resistance line. These are specific price levels where historical data shows a trend is highly likely to pause or reverse. A high probability setup only exists when extreme market location, a long wick with a compressed body, and corroborating trading volume all align simultaneously. The third and final filter is structural confirmation. Even with perfect context and anatomy, you have a strict non-negotiable rule. You must wait for the next candle to fully close before acting. Here is an animated diagram showing the exact visual confirmation required for a hammer. The subsequent candle must open, travel upward, and close decisively above the peak of the hammer's highest point. This proves the buyers are actually following through. To truly confirm the reversal, we use Dow theory as our ultimate structural filter. Dow theory is a financial framework that defines a macro downtrend as a cascading series of lower highs and lower lows. A true reversal is only confirmed when the new price action physically crosses the threshold of the previous lower high. Breaking that ceiling creates a higher high, fracturing the structure of the downtrend. Anticipating that this structural break will happen before it actually does is gambling. Reacting to a confirmed break after the candle closes is analytical trading. High-probability market reversals require undeniable structural fractures in the existing trend to validate the initial candlestick signal. You now possess a fully filtered high-probability signal. The setup has survived the green light system by passing the tests of context, anatomy, and structure. For execution, you have two optimal entry mechanisms. You can enter aggressively, executing the trade immediately upon the close of the confirmation candle, or you can enter conservatively by waiting for a slight price pullback toward the midpoint of the confirmation candle to secure a better entry price. Look at this diagram detailing the risk parameters. A stop loss is an automatic order placed with a broker to sell a security when it reaches a certain price. Here, we place it exactly at the extreme bottom tip of the hammer's lower wick. But we must add a small measured gap below that extreme low to protect against market noise. Next, you determine your target. The logical placement for a take-profit order is at the very next major support or resistance zone on the chart. Before authorizing the trade, check the math. You must ensure a minimum 1-to-2 risk-to-reward ratio. This means the physical distance to your profit target must be at least twice the size of the distance to your stop-loss limit. Professional trading involves executing precise, calculated statistical edges within a strictly disciplined system. Stop guessing and start validating your setups. Practice this multi-factor filtering framework on the FXNX demo platform right now, using our institutional-grade charting tools to refine your precision entries.